today. So long, and thanks for all the fish. Hello again, it's Martin North from Digital Finance Analytics, Webmaster Post, covering finance and property news with a distinctively Australian flavour. Friday afternoon, Tarric Brooker's with me. Hi, Tarric.
G'day, Martin. How are you?
Pretty good, thank you. Yourself?
Yeah, not too bad, mate. Happy to be here.
Yeah, always good when you wake up and find you're still here, right?
You know what? It is the greatest part of life, waking up and realising that you are indeed still alive.
Yeah, exactly. And realisation is you spend 1/7 of your life on a Friday, so it can't be too bad.
No, exactly, mate. And you've got the weekend to look forward to, and not only that, you've got our shows to look forward to about every fortnight. Although after this, not for a little while, as you set off on your adventure to move to the UK.
Yeah, I reckon that we might be missing, one fortnight or worst case 2 fortnights. But folks, don't panic. We'll be back. We'll find a way. 9 hours difference, I think, is the UK to Australian time. Those interested in why I'm moving to the UK, I made a show about it the other day, called So Long and Thanks for All the Fish, with a bit of explanation as to why I'm doing what I'm doing. But just to reassure everybody, still wanting to cover Australia, still running the surveys, and still hope that I can engage with some of those contributors like yourself, Tarric, on the channel, and keep everybody honest about what's going on.
Yeah, mate. I mean, I'm in for the long haul. So you tell me we're going to do it at 9 o'clock at night. That's fine. We'll make it work, and you can put it up the next day. But it's all good.
We'll find a way. And the point is, with the virtualization of the media and everything else, it should be quite possible to do this, and to do rather similar to what we do at the moment, with a bit of a time frame. So I might be able to bring a little bit more contrast with what's happening in the UK as well, because in fact I would argue the UK is about 6 months ahead of where we are in Australia. If you look at what's happening economically speaking, they're pretty much teetering on recession over there, a lot of pressure on households and a lot of pressure on property, and the latest from the UK is property prices sliding further. So I think we can look over there to see a little bit about what's going to happen here.
Yeah, it's going to be interesting to see exactly where Australia falls in terms of the sort of wider comparisons, because we still, even despite the sort of recent moderation in property price falls, which have now perhaps tentatively resumed its more downward trajectory. But that's not uncommon. We saw that in New Zealand, ironically, last February, where property prices went up and people were like, oh, well, everything's going to be great. Everything's going to be fine. Don't worry about it. This is, the beginning of the recovery. And then it just went, and went back off the cliff again. So, I think it's going to be interesting to see where Australia falls, because, we're sort of in this weird position right now with Canada, whereby, low levels of stock are currently holding up the market. But I'm not sure how much longer that's going to really provide all that much help. It's going to be interesting to watch.
Well, the data today from the ABS on new loans really, I think, spells it out, right? So there's a very strong correlation between home prices and availability of credit. When interest rates are low, credit's freely available, prices go up. We saw that through COVID and beyond COVID, when they took interest rates down to stupid levels and all the government stimulus was thrown into home builder and everything else. That's why property prices went up. Loans grew in size, and everybody could get a loan with a pulse. Now, the reverse is true. When interest rates rise, credit starts getting rationed and tightened. The lending standards are actually being tightened even as we speak, so borrowing power is reduced. That's going to put significant downward pressure on home prices. And whilst there might be little wobbles because of stock and those sorts of things, for me, this overarching relationship between credit supply and availability and home prices is proven over the last 30 years. Prices are going to drop further.
Absolutely. And I think that a sort of a bit of context is really needed. And, to once again use what is probably your most used phrase on this channel, you do need to go granular.
Yes.
Because it was interesting, because there was a report in the AFR the other day from CoreLogic that showed that it's actually the top end of the market, the top 20% of the market in Sydney, which galloped ahead. Some places rose by almost 5% over the last quarter, where you saw these big price moves. And that is dragging up the rest of the city along with it. So just because the affluent are getting out there and buying homes, and they still have access to the levels of to strong levels of credit, that may not be what's happening at the median, at the average, and what the rest of the rest of us out there are experiencing.
No, well, that's very true. And of course, if you look at Northern Beaches, for example, which is one of the ones to look at quite closely, prices are still tumbling there. And I'm in Thirroul, which is south of Sydney, down towards Wollongong, and the median price was just over 2.2 million a few months ago. It's now 1.6 and continuing to fall. So you can see these significant movements, if you look granularly. But if you aggregate it all up, then as you say, the top end of the market, where there are still quite a few transactions, actually masks a lot of other stuff. So again, people can actually, throw out these high-level comments and say it's all going to go nice. And there's somebody who tweeted just this afternoon saying my 2-minute take is that property prices have bottomed. Well, we'll see. We will see.
Yeah, we certainly shall, and I think it's well worth, if you are looking at a property, or if you're even just curious about how different areas are performing, CoreLogic's Mapping the Market tool, which I'll put a link to in my Substack post, which will be linked in the description. That is really quite handy because it does show you what's happening at a granular level, at a postcode or suburb level, and I think that's really, really quite handy, because it's all well and good to you can look at a map of, say, Sydney, and you can see, oh, well, Vaucluse is performing well, Killara is performing well. These affluent areas of, where incomes are higher and people are less exposed to rising rates, then yeah, absolutely. But then you look in other places and property prices are absolutely falling off a cliff. So, I think it's really worth taking a look at the data, especially if you're looking to buy, just to see exactly what's happening in the areas that you're looking at, because it may be quite different to what the headline for your capital city or what your region is.
Absolutely. And there's also the other site, which I'm quite interested in, is Spacious, right, which is this relatively new tool that's actually showing the movements in asking prices. And, that particular site colours different movements in different areas, and so you start to get a clustering, and you can see the color and movement. And I think those two tools together give you a really good, more granular view. And I do again say granularity is critical here.
Yeah, absolutely. And it's really interesting as well, because you see that, because you can line it up with different things. You can line up that particular tool with CoreLogic, but then you can also line it up with auction clearance rates from Domain and from SQM, because if you look at, say, like a breakdown of the various different regions of Sydney, the eastern suburbs have been performing relatively well with their auctions compared to the median for the city for probably the best part of almost 6 months now. So that is masking the broader weakness that's occurring in the rest of the market. And that's exactly now what we're seeing in the CoreLogic data. So, you saw that months and months ago, but now you're seeing it, playing out in lag time, so to speak.
And remember that the CoreLogic data is probably a month or two behind, because it takes a little bit of time for the data to trickle through. So it's not really a leading indicator. It's somewhat lagging. And, so what we're now seeing is what happened, November, December. And remember, the RBA didn't put any rates up in January because they were on holiday. So now rates have actually gone up again, so the February rate rise, and they're expecting higher rates ahead. And of course, the ASX 30 is, the forward view is talking significantly above 4% for quite a few months now. So I mean, it's all very interesting. I should be continuing to watch this from afar, but still granular. I'll still run the surveys and still seeing a lot of pressure on mortgage stress there. And again, I would argue map mortgage stress into this too, and you have another perspective. But we should get on and talk a little bit about some of the questions. So we both said, well, let's get questions from the audience, and we have a few questions, I think, to explore in our normal chat fest.
Yeah, well, more than a few today. We may run a little bit long, but we'll do our best to answer as many as we can.
Okay. Right. Well, let's start with the old so long and thanks for all the fish. I think it's a lovely one. Of course, Douglas Adams, Hitchhiker's Guide to the Galaxy, when the dolphins skid-ladled away.
Yeah, right at the end, and right at the end of the world. So it's almost a little bit poetic that you're leaving Australia, just as someone on Twitter said, just as all your prophecies come true. So long and thanks for all the fish. You're off and away.
Yeah, and I did actually almost mean that. I've been forecasting this problem for a long, long time, right? And of course, I was confounded by the fact that the RBA kept taking rates lower, governments kept throwing more stimulus, And people said, you see, you're wrong, you're wrong, you're wrong. Unfortunately, gravity works. It just might take some time.
Yeah, unless you're a dolphin.
Yeah, true. So let's start on the. We'll try and give short, succinct answers where we can, right?
Yeah, we'll see how we go with that.
Doesn't tend to work, folks. It doesn't tend to work.
No, it doesn't. Okay, so the first question is from quite a few people, actually. So it can basically be summed up as, what is going on with home equity withdrawals considering the backdrop of rising rates and falling real incomes? And a big thanks to Martin for pulling this data for me early this morning. It is obviously very much appreciated. And this is the proportion of external refinancers accessing home equity, so withdrawing home equity in cash or some other form. It's really quite interesting because the proportion of people accessing home equity as rates have risen has actually risen, which is the complete opposite of what we saw in the US. In the US, rates rose, people stopped pulling home equity, and even by the time Lehman arrived, the proportion of home equity being withdrawn versus GDP had more than halved. Yet here in Australia, it's still about 10% higher than what it was prior to the beginning of rate rises. So I think this is a really interesting one, because to me, this shows that people can rob Peter to pay Paul and keep the wolves away from the door in terms of having issues with paying their mortgage, but B, also keep up their spending for a lot longer than the RBA would like, just by pulling equity out of their homes. And frankly, you're talking realistically probably still of around about 6.5 or 7 trillion with a T in equity.
Yeah, and it's worth just pausing to say, why is this happening? Well, the reason it's happening because we had an acceleration of house prices dramatically, 20 to 30% up through COVID and through the ultra low interest rate cycle. And so a lot of people still are sitting on sizable paper profits. And of course, as they refinance, they can actually release some of that, and that solves some of their other problems and repay other credit cards and things. And the other thing is that the banks are still, actually, when you look at some of the refinancing calculations the banks are doing, the underwriting standards are still pretty shoddy. In some cases, there are still some lenders who are not doing a new assessment. They're basically saying, well, the last guys gave you the loan, so we'll give you the loan, because competition is so key. And interestingly, somebody today said to me, do you realize I'm being invited by my bank to refinance internally to get a lower loan? They're actually phoning people to say, would you like to refinance? And interesting conversation, that included an equity withdrawal. So the banks are pushing it too.
Well, that's a good one, isn't it? Just I can see the next campaign, instead of waiting for your mate next door with the boat to ask you about equity, mate, someone just rings up and just goes, well, you've got a loan with us. Would you like some equity, mate?
Yeah, exactly right. Help yourself. It's free, quote unquote, right?
Yeah,
And going back to the other point, many people can still service these high loans, right? So whilst we have 45% of households with cash flow issues, that means we have 55% who are fine at the moment, even with the interest rate rise that have come through. And we are seeing wages just tick up a little, but we are also seeing, very worryingly, a rise in personal credit products, particularly for household expenditure. Again, that was in today's data, right? So the other route is, if you can't pull equity out, then get another credit line, get another credit card, use buy now, pay later. And this is exactly mirroring what was happening in the US. If you look at the US at the moment, personal credit is rising dramatically.
Well, I think that's really key. And you saw that in the national accounts a couple of days ago. You've got the household savings rate basically collapsing back to its pre-COVID norms, but it's still nowhere near its bottom where it was in the early 2000s, and neither is credit card debt in terms of credit card debt to GDP, in particular credit card debt accruing interest, because obviously a lot of people use credit cards for the points to roll over every month, and they basically pay it by the time the interest comes due. So there is a whole heap of scope for households to continue spending using credit and using home equity if that's what they choose. And that, in my view, if we follow the same path as the Americans, I'm not saying that we are, but if we do, hypothetically speaking, we could see high inflation for another 12 or 18 months or longer.
Yeah.
That will support it on its own, in my view.
Absolutely right. And we're talking big numbers, right? So we're talking potentially more available through Equity Mate than was thrown through COVID.
Quite possibly over a longer period. I mean, even if you just look at, say, credit cards, Aussies could easily put 35 billion on their credit cards and be roughly where they were relative to GDP just before the financial crisis. And if you whack, 30 or 35 billion at the economy in terms of, going through retail, going through the services sector, that is enough to really to blunt rate rises in a big way.
Yeah. And of course, the other point there is, and Phil Lowe, when he was giving evidence in front of Parliament recently, made the point, no, not everybody is equally positioned, right? But what it actually is doing is bearing down on that proportion of people who have no access to Equity Mate, no access to more credit. They're the proportion of people who are getting squished, and whether it's 10% or 30%, whatever the number, depending on how you calculate it, right? What we've actually got is this bifurcation now between those who are going to be fine over the next year or two, even with higher interest rates, and can pull equity out and, run credit. But I'm worried about the ones who fall off the lorry, because if we have more people effectively falling off the lorry, plus, of course, higher rentals as well, this is going to put huge pressure on individual households and individual suburbs.
It is, and I think, to be completely honest, that's already happening already. I think that's really baked in, unfortunately. We've seen that with higher rents. We've seen that with even, for example, with your own data on rental stress. Like with a mortgage, there are sort of other options that you have, like Equity Mate, like, hardship provisions and stuff like that. But if you're renting, you can't just ring up, it's a lot harder to ring up your landlord and be like, hey, can I pay, whatever the equivalent of an interest-only loan is, pay, 2/3 of the rent for the next year or 18 months. You can't do that. So, it's quite a challenging environment, unfortunately.
I agree. Next question.
Okay, well, I've got a couple of other charts on this question.
Oh, okay.
This is US home equity withdrawals as they played out, as you can see, when rates went up in 2006. Home equity withdrawals peaked and went down in a big way, and were basically mostly, at more than 80% gone by the time the Lehman Brothers event arrived. So it's really quite interesting in that regard. And also, just for those wondering, we've also got a chart here, because the thing is if you show the whole chart, you can barely see everything that's gone on at the end. But if you with the whole chart here, you can see that basically home equity withdrawals were basically non-existent, not quite non-existent, but they were a very, very minor factor in the early 2000s. And they basically risen almost 13-fold as a proportion of people refinancing. Yes.
And if you overlay then house price growth, right? I remember that we've had a couple of cycles of house price growth. We had a quick run up, 2014 to 2016, and then we've had a run up from 2020 to 2022. So actually, there's a strong correlation between this massive increase in property values and the ability to just magically pull money out from nowhere and then say, hey, I can go spend it on a boat or whatever, or pay down other debts. This is a direct consequence of these massive manipulations of home prices.
It is, and I think it's also evidence as well of the Equity Mate economy. Because, if you look between the early 2000s and say 2012, which is basically when the tail end of the mining boom ended and you started to see flat real household disposable incomes, Equity Mate wasn't really a major factor. It was still only about 5% of refinancing borrowers in this particular context. Yet it's risen more than 7-fold since then, because the economy has gone nowhere in terms of the outcomes experienced by households. And to be completely honest, if you actually look at, more recently from 2021, 2022 onwards, it's risen even further because people have fallen further behind in terms of their real incomes.
No, that's true. It's interesting that AMP put out a thing yesterday, which was talking about mortgage stress. And one of the points they made was something like 60% of loans are only about 3 years old. Or, in other words, a lot of people moved quite recently. So again, we've got a lot of people potentially older with smaller mortgages with lots of equity, and you've got more others that are actually trapped in situations with very little equity. So again, you've got this bifurcation of those two cohorts again.
Agreed. It's the K shape all over again.
Oh, yes.
Okay. Next question. Nick asks, do you have any good charts or data on when the bulk of fixed rate and adjustable rate transitions will happen? Yes. Yes, we do. Okay, on the left here, we have one from Westpac that basically shows that by the end of September this year, almost half of all fixed loans would have expired. And on the right there, we've got a good one, which is fixed loans in aggregate, which is from the Bank of America, which basically shows that it is very much a 2023 story in terms of when these loans are going to expire. But I think it's also just worth noting that while we are heading for the bulk of these loans to expire within the September quarter and prior, it's going to take a while for this to feed through. It's not going to be an immediate, cliff as it's described. I think it's going to be something that's going to be a little bit more of a slow burn. But I think it's probably going to be a lot even more painful than the sort of commentary would suggest in the long term.
Well, I think that's probably right. And it's also worth noting that quite a few households have a split loan. So some of it's variable, some of it's fixed. So they are already experiencing some rise on the variable component. And now they've got this other nightmare when the fixed is reset and, almost certainly will go from like 2% to 6% or whatever. I mean, that's a bit of a scary situation. The other point to make is there's a difference between loans and households. And it's interesting how a lot of the commentary has completely scrambled the two. So they talk about 900,000 households. No, it's 900,000 loan facilities, right? Now, it might be a smaller number of households. So it's really interesting and important to understand the difference between the two.
Yeah, and I think, to once again go granular, it's also the fact that just because the household has a fixed loan, it doesn't necessarily mean that household is going to be in trouble. A household with a $50,000 mortgage may have refinanced from a 3.5% variable rate down to a 1.9% fixed rate,
Yep.
And they're going to be laughing. It's not going to matter to them in any real major terms. It's going to be minor, but so really it's also about the value of the fixed loans expiring and the people who hold them. And I mean, I think the really struggling people are going to be the people who borrowed at high debt to income ratios on these short term 1.9, 1.89% fixed loans, who are first home buyers or people who have taken on these large loans to upsize. They're gonna have some pretty major problems going ahead. And I think that I'm gonna say this. It's maybe a little bit controversial, but what's new? I think if we had the same settings as America in terms of the same laws, the same recourse, the same underlying settings from the government, the regulator, the central bank, etc., Australian property would just be on the edge of getting smashed over a cliff right now.
Yep.
But we don't.
No, we don't. Although the 3% buffer is still present according to APRA, so they're not going to trim it for now.
I get the feeling that that's going to be trimmed at the most opportune time.
Yes. It's coming. It's
coming. Why waste the ammo now when it's going to be ineffective? Wait until inflation comes down a little bit and you can make a bit of a narrative. Rates have stopped rising. There's no point handing the buffer now and then you have rates rise by another 1% or 1.25 or whatever it ends up being, according to the market or even the major banks. So yeah, but if they wait until rates peak and then it's like it's going to be off to the races again, maybe they can fire up something of a recovery for a time.
I think that's probably right. And the other point interesting on that, it's somebody asked me whether the 3% was actually BAL induced, and the 3% buffer itself isn't. The regime allows for that to be determined, but the mechanism is actually down to the individual regulator within each country.
Yeah. Okay, next question. MSR asks, with immigration, the rental crisis, a peak RBA rate of 4% in sight, is there a point when we will see investors pile back into the housing market, or is this unlikely with RBA if the RBA's cash rate stabilizes at 3 or 4%?
Property investors. Well, 20% of property investors already left the field, according to my data. So they're already locked. And why? Simply this. One, property prices aren't going up. And if property prices aren't going up, there's no capital appreciation. That basically means an investment isn't working. Two, the rental increases that many people have been able to put through are insufficient often to cover the actual true costs in net terms of running the investment property. And there are new regulations in with regards to things like construction standards, things like fire alarms and other things which are making it more expensive for investors to actually maintain the investment property. And of course, the government has actually trimmed some of the tax relief that's there too. So those are some of the factors in the background which suggest to me that we may not see a big splurge from the retail, mum and dad investor sector, but we might well see build to rent coming through quite strongly. There are a number of quite big initiatives in New South Wales and elsewhere where effectively a commercial entity has been created specifically to build property down to a price, to rent up to a price. I think we're going to see a lot of that, and so we might find a different mix and style and character of those properties, but most of those will be high-rise. Most of those will be cheap and cheerful in terms of construction, but extremely expensive in terms of cost of rent. And in fact, Cameron Murray did some work quite recently to show that this particular characteristic of this build to rent sector typically adds about 15% to the cost of the rent.
Great, sounds perfect. All right, I'm just going to put this chart up of. A lot of people have said that there's the issue of immigration and that's going to help boost the housing market. And yeah, in terms of rents, absolutely. It's going to make things a lot more difficult. It's going to put down additional downward pressure on the vacancy rates. But in terms of actual permanent migrants, the proportion of permanent migrants actually purchasing a property is around about 17% in the first year. Now, that's purchasing both paying with cash or also just getting a mortgage. However, it's also important to remember that this particular data is from 2006. I've looked for better data, but I haven't yet to come across it. So this was at a time when people were coming from places like Britain and other places overseas where they could come sell their house in London or in pretty much any UK city and come here and buy a house. Mm. And obviously, that's no longer anywhere near as much as a factor. So, but to go to the broader question, I don't think that we're going to see this big investor-led recovery in property prices, mostly because investor-led recoveries in property prices, they don't really happen. Property prices rise on the back of owner-occupiers and in Australia in more recent years, first home buyers, mostly because these upswings in prices are driven by lower rates and usually some form of government incentive. So first home buyers are the first ones to, hold their nose, jump in, and just get into the market because, well, that's the way they have to do it because, for a lot of people, there aren't any other options. So if you look at, say, for example, the ABS housing finance data, investor activity lags owner-occupiers and it lags first home buyers. So I think if we are going to see this investor-led recovery in property prices, the rest of the market in terms of owner occupiers needs to recover first. So, and I don't really see that happening anytime soon because there's not really a whole lot of incentive because the yields are already garbage in terms of gross yields, and they're obviously that's a gross generalization. There are obviously pockets of places that are you can get a positively geared property, and if you can, good luck to you. But for the most part, they're garbage yields. So. Yeah, and once you factor in net yields, well, forget about it.
Well, I was going to say net yields, typically below 1% for many people, negative for about 40% of property investors at the moment. Compare that with 4.5 to 4.9% on a term deposit. Pretty obvious, isn't it?
Yeah. Well, I mean, not only that, but one of the ththings I think is really interesting is I do wonder how things would look if someone explained bonds to property investors. Right, because you can buy, you can buy a long duration Australian bond. You can buy a 20-year bond. You can buy a 30-year bond. You can buy an ETF with long duration bonds. And if you are 100% convinced that rates are going to go off a cliff, you can get 30, 40, 50% returns on that ETF. And not only that, but collect the bond yield in the meantime.
Yep.
So that to me sounds like a better bet than property, but that's just me, and that's not financial advice.
No, I was going to say we don't give financial advice on the channel, but it's interesting. There's other structures. I'm thinking of some of those annuity type structures now, which actually are quite characteristically different. Some inflation protected annuities and things like that, right? The point is there is a pantheon of other options now. Property is actually not necessarily in first or second or even third place at the moment. So another reason why many investors are going to say, no, I can find better elsewhere.
And one of the things I honestly find the most interesting is if you love property, you think property is great, there are other options. There are real estate investment trusts, there are listed real estate investment trusts, some of which have been smashed into oblivion in terms of, their net asset value by rising rates. And, if we do see another leg down in the stock market, they're going to get hit even harder. Yep. So the yields are actually pretty good. So, I mean, obviously do your own homework and, case by case basis and all that. But I mean, if you're looking to invest with cash, just, do your homework. There might be something better than property out there.
Absolutely right. And, as with all of this, get independent, structured advice from somebody who knows what they're talking about, because it's too hard to pick it just the top of the end. There's still a lot of people who say, oh, I never lose on property. All right. Well, I can tell you in my surveys, I'm seeing a lot of people losing in property at the moment. So property is not a dead cert.
No. All right. Nikolai asks, Westpac has forecasted 7 interest rate cuts in 2024 and 2025. Sounds a bit too specific to me. Do you think it's wishful thinking given the time frame and the RBA's inflation targets?
Well, what are the bank economists doing? Right? They're talking their own book. Right. What they're trying to do is to alleviate any investor worries about, stress within their portfolio. So, of course, they all want to see interest rates, come down and, the boom to come back again. But have you noticed how they keep pushing out when rates are expected to come down? I mean, Phil Lowe is still saying they're not going to actually hit the inflation target, in 2024. I think it's 2025 now. That's his latest view of when it's going to be there. I'm not sure anybody can actually predict that. And the Federal Reserve is still talking about lifting rates higher, so that's going to put more upward pressure here as well. There are so many reasons why interest rates are more likely to stay higher for longer rather than drop. But I would argue again, some of these bank economists have a particular vested interest in spinning a particular story. And how objective are they? Well, probably not hugely objective. They do also change their tunes quite a lot. ANZ, for example, has been up forecasting again and now saying it's going to be higher for longer. CBA tends to be sort of somewhere further down. So who's got the biggest loan portfolio? CBA. Well, it could be connected.
For me, I think it's going to depend on whether or not we have a recession. If we have a recession, they'll probably cut rates, that much or more. Because whether or not we get inflation under control is entirely another matter. I think that we could still go in and still have 3% core inflation, and the RBA would still cut rates if headline inflation came down below their target, even for a little while, if the wheels really, really fell off. So, I think it's possible, but I think it's one of those be careful what you wish for sorts of things. Like a lot of people are wishing for rates to go lower, and they may go lower than they are now. But what exactly is going to go wrong for that to happen?
Exactly. It's a sign of something, isn't it? So it's going to be a sign of the economy weakening, recession, all of those things. And, the chances are the US will have a recession. There's probably already a recession in the UK, although it might be quite shallow. Eurozone probably too. And so these sort of negative cycles are actually tending to reinforce each other. And the only blunt instrument they've got at the moment is interest rates, unless the Reserve Bank review that's coming out relatively soon now makes some alternative suggestions. But don't hold your breath for that either.
Yeah, even if they do make some alternative suggestions, there's the issues of the downsides of those suggestions. Like, don't get me wrong, there are fiscal policy options.
There are things they could do.
Yeah, there's things they could do. They won't do them. But if you did have the RBA somewhat abrogate its responsibility, for monetary policy for keeping inflation in check, the Australian dollar is going to end up doing their job for them.
Spot on.
And so will the bond market.
Yep. Watch the bond market, folks. I think that's where we'll see the cracks. And remember, the bond markets are continuing to go higher and higher and higher and higher. And in fact, the 2 and 3 year is inverted in Australia now, for the first time.
Well, interesting times ahead. I think it's only a matter of time before we see a more full on inversion. But
Watch.
exactly. Just keep an eye on the time. All right. Homer asks, given levels of government debt in Western economies, how can the current standard of living be maintained without zero government interest rates?
It can't. I can't
Yeah.
see a way of it. Can't see a way of it doing. The only thing that supported the standard of living over the last 20 years is quantitative easing and ultra low interest rates. That's the reason why it's less bad than it would otherwise be. It's not real though; it's illusory because real incomes have not grown for the last 10 years, and so many people are still worse off compared with previously. Apart from the few percent who are actually holding all the assets and have enjoyed massive wealth growth. So it's a very distorted picture. It goes back to, again, to not everybody's in the same boat. Unfortunately, most people are in the wrong boat. They're in the boat labelled paddle really hard to keep your head above water, rather than the speedboat that's got a sort of a dial that says full speed ahead, don't look back.
Yeah, I think for me it's a question of time. Can they keep rates high for a year, 2 years, 3 years, and just basically print deficits in order to keep that going? Yeah, I think they probably can. I think that there'll be debt crises in the developing world, maybe even if it goes on long enough in the developed world. Particularly if you do start to see some form of political fragmentation in the eurozone.
Yeah.
But to me, something else is going to break first.
Correct.
You're going to see corporates break. You're going to see the commercial, mortgage-backed securities market break. You're going to see, economies break before, these sovereigns do. And I mean, don't get me wrong. I think that in on a long enough time horizon, they've all got problems, big problems. But in the short term, I think that something else will break first.
Yeah, I'm watching the US debt ceiling. I think that's going to be a very interesting little trigger for something just a few months down.
Yeah, well, considering the jokers that they currently have in Congress, yeah, I wouldn't be surprised to see it driven to an insane 11th hour deal, or even a technical default. I mean, it's a clown show. So.
It is a complete clown show. Yeah, politicians and those who claim to be politicians, really, a lot of them have no idea.
Yeah, pretty much. I'll leave it at that so I don't get myself in trouble. All right. Eurovibes asks, what could the impact of housing prices? What could the impact on housing prices be if the majority of first home buyers start getting 40-year mortgages?
Yeah, so it's an interesting question. If you've done the maths on an extended life of a mortgage, it does actually reduce slightly the monthly repayments. But once you get above 30 towards 40 or 50, actually the incremental benefit that you get is really very, very low. Why? Because you've got this massive interest bill accumulating for a lot longer. So actually there's a diminishing returns point, which is probably about 32 to 35 years. Above that, you hardly get any benefit. All you're doing is just locking up more profits for the banks because you'll be paying for a lot longer.
Yeah, pretty much. I mean, I put together a little chart here of what you can basically afford based on your income on the bottom, what you can afford in terms of a house price on the back. And this assumes you have a 20% deposit and you've got cash for stamp duty and other transaction costs. And basically it increases your borrowing power by about 9%. So yes, it could help prop up the market somewhat, but we're also in the midst of a market where borrowing power is down over 30%.
Yep.
So it's not something that could rescue the market single-handedly. Is it something that could, put a rocket under it?
So you could have 40-year mortgages and a reduction in the interest rate buffer, and you have a cutting of the interest rates, and you have a bit of government stimulus. You can pull all the levers, and you can probably get another sort of wobble up. But the cost of doing that, we are close, I think, to thresholds where, in fact, if they do that again, it's going to blow up. So I'm not totally convinced they will do it or can do it. But the pure maths is that you can extend the life of the mortgage. It's a 100-year mortgage if you like, but if you calculate the interest that actually represents, it doesn't actually really increase the borrowing power sufficiently to cover what we would need to see it covered. Borrowing power actually for many people is down 40% now.
Yeah, and I mean, one of the things I think is interesting that sort of just needs to be emphasized a bit is that the national median household income is only about $93,000. Now, I realize a lot of people are going to look at that and they're going to scoff and they're going to go, "What? I earn more than that," or whatever it is, and but that's what the figures say.
Yep.
That's what if you take the 2021 census data, I'll put a link in my Substack post. You take the 2021 census data, you add on wages growth, it's about $93,000. So that basically means that the median household can only afford a house that's probably just a little bit under $500,000.
Yep. I remember it used to be 3 times the first income plus 1 times the second income. That's what the banks used to use.
Well, and we had higher home ownership rates. Who would have thought?
Yeah, exactly. Now it's sort of 6 to 8 times plus, and more people are spending more of their income just trying to buy somewhere to live. And unfortunately, we've got now a generation of people who think that's normal. No, it's not normal. It's extreme. It's been created by bad policy.
Yeah, and I think it's just worth emphasizing as well that it's completely undermining the economy. People, I find it astounding that the link between stagnating real household incomes, real household, disposable income per capita, and the fact that we don't have any don't have any growth isn't really put together. I mean, even more recently, if you look at per capita growth, per capita growth over the last 2 quarters amounts to 0.1%.
Yep.
It's a joke.
Yep.
But no one, very few people go, oh, well, what about all this household debt? It's sucking in one in every $6. By the time the rates rise cycle is over, it's going to be 1 in every 5. So, it's like,
absolutely.
If you can't spend the money in the economy and it's all going to the bank, and then it's all going, a lot of it's going off to offshore investors, then well done.
Exactly. Goes back to that point. There are a few segments of the population doing really well, but everybody is just paying. And I remind people, you are a cash flow, right? You are perceived to be a cash flow as long as you go on paying and paying and paying and paying. It doesn't matter how long, it doesn't matter how big, as long as you can go on paying. It's when the music stops that everything goes wrong. And we're close at the moment to the music stalling, because the proportion of disposable income that more people are actually having to now pay on those mortgages is getting to a point where it's excruciating, unbearable. And of course, we still have high inflation. That's why this is a critical point to, maybe think hard before you actually up that mortgage again.
Yeah, I mean, I think that's something that sort of, just needs to be, emphasized a little bit. It's just that I don't think that the RBA or Treasury or a lot of other organizations, and probably including the banks, have fully grasped how much things have changed. If the psychology of Australian consumers has changed to the same degree, say, for example, as Americans, and they are just going to keep spending, and they're just going to, reduce their levels of savings, maybe even spend their savings, they're going to take on more credit, take on more debt, take on more equity, mate. If they're going to do that, the idea that inflation is going to come down anytime soon is basically completely kaput. Yep. Which is basically German for completely finished. So it's done. So if that is the case, all these forecasts are going to go out the window. Rates are going to go higher, and we're going to have all manner of problems. And there's going to be, and not only that, but then you've got the social issue of the fact that there's going to be a subset of Australians who are going to be getting completely crushed, and there's going to be other Australians doing very, very well.
Yeah, well, we've spoken before of this bifurcation between, the haves and the have-nots in Australia. Unfortunately, the distributional aspect of that is getting worse and worse, but it's by design, right? And it's also driven by this marketing-led. You want to have it today, right? You don't want to wait till tomorrow. You don't want to save first. What you want to do is get credit, right? Because we have presented to us an alternative philosophy of life, which is debt's fine, more debt's better. Enjoy yourself, right? Unfortunately, there are some limitations to that strategy, particularly when interest rates rise.
Yeah, and I will just add to that it's not just, the credit thing. I mean, the credit thing is naturally huge, and there's obviously all manner of issues attached to that. But it's also just the fact that in relative terms, people, choose to live quite dangerously. They choose, and I don't mean that in it, they're going to get eaten by a shark, or, they're going to go, try and outrun a cheetah or something silly like that. I just mean that in decades past, people were taught to have a rainy day fund, to be able to bail themselves out if they got into trouble, and that's something that I had instilled in my, from my parents and my grandparents. who are, of a, an older generation than yourself, Martin, and basically the problem now is that people just expect the government to step in and bail them out, and COVID has only further reinforced that. And people just expect, oh, the government won't let that happen. The government won't let that happen. It's like, well, maybe you should just look across the Tasman at New Zealand and what the government is letting happen, and the fact that you've got the governor of the Reserve Bank of New Zealand appearing before Parliament and saying, "I am trying to cause a recession. Deal with it." Now, while Phil Lowe might not do that because he wants to keep his job, well, that might be what he's trying to do.
Yes. Well, there's no doubt that they want to dampen, and they're trying to steer this, quote, narrow path, right? That's soft landings, narrow paths. We keep hearing those. It's bullshit.
I got to say, mate, when you use language like that, it just rams it home just beautifully. And I'm not going to add to that, just to add to the poetry of that. And I'm going to move on to the next question.
Fair enough.
Okay, Herbivore asks, how tied are interest rates in the US to us in Australia? What is the minimum maximum difference between interest rates, and when did that occur?
Yeah, have you got a slide on that? Because
I do. Okay, well, I'll start this one. Okay, now, basically, the biggest gap was, off the top of my head, around 9%, which occurred during the 1990s, just in following the 1990s recession. Sorry, during the 1990s recession, just before things really fell to bits. But more recently, it's been about 1.25%, and that occurred just prior to the pandemic.
Yeah, and I think that's probably a reasonable stake in the ground, which basically says if the RBA looks over to the US and sees the Fed lifting rates, they've got to follow. They can't let this go too far, because, of course, there's a really significant impact on the exchange rate.
Yeah, which is what I've graphed here in blue.
Yeah, because if the exchange rate drops, imports become more expensive. And that basically means that we import inflation. And that then makes it much more difficult to be able to conquer the inflation issue. So, like it or not, we are lockstep with Fed policy. We're not unique, independent. We're not able to say, we can just ignore it and carry on. No. Within bounds, you've got to actually keep this roughly in kilter. And that's why this is a really important slide.
Yeah, no, I concur. I mean, like, you've got the historic, 1.25%, which we saw during, just prior to the pandemic. But, more recently, I would say that based on the forecasts I've seen from the banks and I've seen from the market, there's realistically about a 1.4% gap, which it may be sort of considered under the right set of circumstances. Now, I should very much emphasize here that it's very much dependent on bond yields.
Correct. As
to what the RBA does, because if bond yields really take off, both here and in the US, and then they've got problems, because the differential between the cost between the value, the return on an Australian government bond and a US government bond, if it blows out too much in favor of the US bond, then, well, less cash is going to flow to Australia, more cash is going to flow to the US, and that will then put further upward pressure on rates, and further downward pressure on the Australian dollar. So I think that's really something that's worth emphasizing, because we could see another run up in bond yields, and quite a few people are predicting that. Some people are predicting new highs for US long bonds, and if that happens, the pressure is going to be right on the RBA.
And bear in mind also, there's a pressure on the banks, because they are having to fund their books, most in international markets. They're going to have to pay more. That's going to put more upward pressure on the rates that they charge, because they have to try and massage their margins or steal more from depositors again.
Yeah, well, yeah, basically. I mean, you've got not only that, but you've got the issue of the TFF, all that funding coming to an end.
Oh, yes.
So, the banks, are going from basically, having to, pay, they're paying 0.1%, and then they're parking a fair amount of that at the RBA and getting a return.
They're getting a return on it. Yeah, that's right. So they're moving from that to actually commercial rates. I still think there's a significant chance we're going to see a TFF version 2.
Yeah. Well, inflation permitting. inflation permitting. I mean, if they want to crash the currency, they can go for it. But, well, I mean, I wouldn't rule that out. So.
Indeed.
But yeah, I think that sort of 1.25, 1.4% sort of gap is going to likely be maintained. But I think it's also worth noting then that you've got people like, say, Bank of America. They're talking about a US Fed rate of 6%.
Yep.
And that's, you're not talking about some fringe, forecast. You're talking about one of the largest major banks in the US.
Absolutely. Well, Jamie Dimon said the same.
Well, exactly. So now you've got basically two of the biggest banks in the US talking a 6% Fed rate. So if you then implement that 1.25, say 1.25, 1.4%, that means a cash rate of 4.75, 4.6 to 4.75.
Yep.
So, and if bond yields really take off, maybe 5%. So, these are plausible scenarios. So, if the wheels don't fall off, that is.
Yeah. So the question is, which wheel drops first? We'll watch this space.
Yeah. Which and when? Okay. Electrofried asks, thoughts on the impact of the mortgage cliff while at the same time having our first recession in 3 decades? Bonus round, if you could touch on buy now, pay later and how that could be factored in. Could it prop up household spending well into a recession?
So let's do the buy now, pay later bit. So definitely some people who are in difficulty have been reaching for buy now, pay later as an alternative to credit cards. And unfortunately, about 20% of them end up paying excess fees, which means they end up paying more than if they were using a credit card in the first place. That's the first point. The second point to make is that the distribution of buy now, pay later, payday loans, and more credit cards is very strongly aligned to those under mortgage stress. In other words, people are looking for alternatives. And so what we have is a situation where a group of cohorts are actually really stuck and they're reaching for anything that's feasible and possible. Now, it's worth remembering, of course, that buy now, pay later is potentially being regulated. The question of is it light or heavy or medium regulation, we'll know quite soon. It should be seen as a credit product. It's not seen as a credit product at the moment, which is a major mistake. So it's definitely an important factor. But if you look at the total amount there, it's not huge. So it's not alone sufficient to make or break the market, but it's a signal of a broader set of issues. When people have problems, when they're trying to square the circle between money in and money out, most people, rather than trimming what they're spending, try to find a way to bridge what they're doing, credit cards, buy now, pay later, payday loans, and pay the interest and hang it. That's how they think. Unfortunately, all my surveys and analysis over many years suggests that leads ultimately to significant pressure and significant difficulty, and quite often people have to refinance and then pull equity out to be able to pay down those loans, do it once or twice, and then the third time they often have to sell and get out. So it's not a sustainable solution.
No, I mean, I think it's going to depend not very much on what this upcoming economic downturn looks like. I mean, we've already seen the economy in terms of consumer economy basically just go flat in a lot of ways. Some states are going backwards. But I think it's going to depend on how things evolve from here, because the US had 2 quarters of negative growth last year.
Yep.
And inflation still kept going, and inflation now is reaccelerating. So I think it's going to depend on exactly what the circumstances look like. I mean, we could see, ironically to me, the worst case scenario for the economy is that it actually just keeps kicking along at roughly this sort of kilter. Yeah. Because the RBA is going to have to just keep jacking up rates. It's going to have to keep chasing the Fed, and it's not going to have any justification to stop.
Yep.
So that to me is the worst, is aside from, the sort of cataclysm scenarios, it's probably, the worst option. If we just had a recession and inflation got downward pressure, then it would be different.
So here's the trick then. If you want the RBA to stop lifting rates, stop spending.
Yeah. Well, that's the thing, isn't it? Like if you want the RBA to stop raising interest rates, then write to your local member of parliament and talk to them about some of the tax concessions that you may or may not like, or you don't like that. You prefer lower rates over someone else getting a tax concession.
Absolutely right. Yes. Now we're getting into it. There's a whole political
exactly. You take negative gearing out of the equation. That's another couple of billion. Another couple of billion a year for the government, but it's a couple of billion that doesn't have to come out of the pockets and out of the economy out of mortgage holders.
Absolutely, and that takes us interestingly into the sort of the superannuation discussion and the 50 billion and what have you, right? So, a very minor change there, but it's worth just reflecting on how much it's costing the overall economy just to maintain the superannuation system. It's going to be more than actually the retirement system, the pension system, which is crazy, really.
Yeah, it is. And we can revisit that, but I just want to just I did do some slides for this particular question.
Yep.
And basically, you recently, there was basically a 4.4% cash rate priced into ASX futures at the close of the market yesterday. It was about 4.18. And on the right there, we've got how many borrowers are going to be in serious trouble at a 3.6% cash rate. So this comes back to what we were talking about before. If we had US type settings and 15% of households in negative spare cash flow, well, you'd be looking at the housing market falling off a cliff.
Absolutely.
So it's all very much dependent on what the government is going to do, what the RBA is going to do, whether we see TFF 2.0 or, what sort of intervention we end up seeing, or whether it's just, extend and pretend for as long as humanly possible until it's no longer viable.
And of course, the government keeps saying we've got a huge deficit. We've inherited $1 trillion of debt. Blah blah blah. We don't have capacity. We need to find ways to trim rather than actually expand. Interesting narrative, but maybe words and figures will differ.
Well, that actually leads into a question that Cade asked. Your thoughts on the stage 3 tax cuts in the inflation fight? They'll be coming into effect at an interesting time. Well, they certainly will.
Yeah, absolutely. They should not be going ahead, in my view. It is iniquitous.
Well, let me put it this way. This just comes back to what we were just talking about then, doesn't it? The fact that, okay, if we're going to put an extra 20 or 25 billion into the economy every year in terms of tax cuts, to offset that, rates will probably going to have to rise more than 1%. So, depending on exactly how the calculations stack up at this level, at least 1%. So, to offset that. So, yeah, okay, if they want to go ahead with that, they're gonna blow out the deficit. They're gonna hit things, and they're gonna make the inflation problem worse. And although I will say, I am an old school fiscal conservative, believe it or not. And, I think that realistically we should be making sure that the budget's on a better track. But on the other hand, I also think that we need to be looking fairly seriously at the expenditure levels of government and what would you call them? The bullshit jobs, the useless people who collect paychecks who had basically nothing to our collective nation.
Absolutely, yes. The people who turn up but don't actually add anything. And it's worth just making the point that the stage 3 tax cuts benefit the more affluent significantly, right? So the distributional aspect is precisely what you wouldn't want to see. What you actually want is to get some of that money down into the sections of the economy where people are really hurting and where things are difficult, not just bringing the rates down for the more affluent. That's the problem with it. And of course it's a sort of neoliberal philosophy, I suppose, but to me it's stupid. It should not be allowed to go ahead. Will they? Should they? And of course, if they do, then they're going to be caned by the opposition, aren't they, for breaking yet another policy?
They will, but to be completely honest with you, I have actually been surprised at how poorly Dutton has performed. Mostly because he's been given so many free kicks that he just hasn't taken.
No, I know. Yes.
You're from the Liberal Party, you're from the party of small government, and then Albo turns around, Westpac's talking a net migration figure of 400k.
Yep.
When Albo was talking about 160k permanent migrants being too many, It's like, mate, you're missing the free kicks in a big way. You're getting your ass kicked in the polls. I get that you have your own agenda, but if you keep going the rate you're going, it's not going to be your agenda anymore. It's going to be Angus Taylor's or someone else's.
Yeah, no, I have to agree. And of course, the other point there is that I think they got a bit distracted by The Voice and some of the things around there, and a few of the important but not critical issues that I think should be being discussed. But I agree, he's not performing at all well. And by the way, the Labour government, of course, isn't tackling any of the big issues. They're sort of tiptoeing around the edge and doing little things that they can claim a little bit of a media bite, like the superannuation things, but they're not wanting to tackle the fundamental questions and issues that we're actually facing. I'm afraid both sides of politics to me are not necessarily doing what I would want them to do, and I have a feeling that they're rather similar in terms of many of the philosophical drivers that are actually driving them to do what they're doing.
Yeah, I wonder sometimes, like, it's a bit of a stretch, but let's just explore this theory for a minute. I do wonder sometimes if they're baiting Dutton into doing something stupid, which he's done, right? He's turned around and he's supported a policy where basically he wants to protect the superannuation tax concessions of the top 0.3%. Now, leaving aside whether you agree or disagree with that, at the end of the day, it has very, very wide popular support. It's popular to the point where they're making fun of how stupid people are who oppose it on morning breakfast television.
Yep.
That's how it's seen. There's jokes, there's everything. Now, whether you agree with that or not is up to you, but that's how it's being seen by the wider public, and Dutton is getting caned for it. So I don't know why he's doing that. But now, if they do turn around and they go, well, we're gonna pull the stage 3 tax cuts, they've now tarred Dutton with the "I support the 1% brush." So maybe they they modify them. Maybe it only goes up to X or Y level instead of going all the way up to the top. So I think that's really just worth just sort of exploring as a potential sort of political backdrop.
No, I think they probably will make some changes, but they won't throw the whole thing out. I think that's probably where it'll end up, but we'll see. Time for one more, I think, Tarric.
Okay. Julian asks, UK versus Australia in 2023 and 2024. You and Martin's view. Knowing the UK election is due in 2024, followed shortly by an election in Australia, are Labour and Labour wins on the cards at the moment?
Certainly in the UK, he's quite far ahead, although in fact Rishi Sunak has pulled back a little bit. And the recent solution of the Irish problem potentially might give them a little bit more wriggle room. And of course, also the energy prices are coming down, although the energy price cap, which is effectively the government supporting consumers and small businesses, they're still putting energy prices up, so the cap's being reduced. So there's a lot in play. But I do think that at the moment, many people in the UK want an alternative. Because they've had the same sort of flavour of government for a long, long time. And, if you think of some of the colourful characters that have been PM over recent times and some of the things that they've done, you sort of think, maybe we want somebody sensible, and maybe we want somebody who's trustworthy and who actually says what he does and does what he says, right? So that's where that is. The economy in the UK is very close to recession. They didn't actually quite get into recession, but it was a sort of 0.1% growth, so over the last quarter. So it's very, very worrying about what's going on there. The cost of living continue to rise. And guess what? They run out of tomatoes and capsicums or peppers and things the other week because the international supply chains are being directed to Europe rather than actually to the UK. So they've got a few issues post-Brexit too. So, but Labour, I think, is most likely there. And I said earlier on, I think in a way the UK is further down the hill compared with Australia. I think that the impact of higher interest rates and some of the other things, will play through into Australia. I think that it is quite likely, though, that the opposition will not muster itself here in Australia in time for the next election. So unless Albo does something really stupid, he's probably going to sort of be a safe pair of hands and try and muddle through. But I do worry about energy prices. I do think that's probably a sleeper, and I do think that some of his commitments that have been made to things like green and low carbon economies and things, those are issues that could still bite. So it's not necessarily completely certain.
Yeah, I would broadly agree with that. I think that the Aussie economy is going to do better than the UK economy until it doesn't. I know that's a little bit of a how long is a piece of string sort of answer, but I mean it's also going to depend on how China performs heading into the rest of this year. If the Chinese consumer economy and services economy fires the way that the bullish narratives would suggest, then there's no need to import as much iron ore from Australia.
Correct.
because why
Why
waste
would you?
resources? Exactly. Why waste resources building all these bridges, building all these things to prop up GDP if GDP is just doing just fine on its own? So, I think that it's going to depend very heavily on what China does. But then by the same token, if you've got a struggling China, struggling Europe, struggling US, well, then we've all got problems.
Absolutely. And I think that's the key point to understand. This is more a global problem than it is a particular country problem, right? We have a set of parameters at the moment, a set of uncertainties. And we've said in previous shows, I think, never known so many uncertainties all playing out at the same time. And I think that's probably true. And, there could be other things. There's avian flu in the UK, right, which is a bird flu, right? Well, they're worrying about that now, crossing the boundary and potentially infecting people, right? And so there's other things out there. So expect the unexpected is my sort of maxim for both Australia and the UK over the next few months. But I guess, we'll pick up the theme in a couple of cycles time, so we'll probably miss one in 2 weeks and maybe the following week, or maybe I can get going soon, and that depends on the UK. But I reckon there'll be a lot to talk about.
There will be indeed, and I just want to take a moment to say thank you for all your efforts here in Australia. Obviously the shows will continue, but it's something of an end of an era. So I want to say thank you to you for providing the opportunity for us to have a chat every couple of weeks and to put this out for so many of our great viewers. And also, I just want to say thank you to the viewers for watching, for commenting, for sharing your perspectives on things, and also for the support you've provided to me personally on Twitter, or whether you've made a financial contribution. It's all very much appreciated, and I just thank you.
Yeah, no, I absolutely echo that. I think there's a great community out there, and so many people have actually been listening quite intently to some of the things that we've been saying. Whether you agree or whether you don't agree, but in a way, that's not the point. It's a chance to engage and interact. And so thank you for all those interactions. Thanks for all those messages of support and even those criticisms. We do take them all seriously. And I just want to say to you, Tarric, I've really enjoyed, the interactions over the last few years. We've always said things are going to get interesting, and they sure prove to be. But I think they're going to continue to be interesting. And I look forward to continuing our dialogues in whatever the format and timing. But, we'll try and do it in a roughly similar fortnightly sequence after I relocate. The reason I should explain why I need to actually take a bit of time off, because this studio is very complicated and I've got to start taking things apart, and it's going to take a few days. In fact, I had Edwin over today and he posted a photograph behind the scenes on Twitter of all my spaghetti. I've got thousands of cables and things. And somebody said, well, just do it on an iPhone. No, you don't understand, right? This is quite a complicated setup with the fading and the moldable images. It's all done in real time. It's all so there's a technical reason why it's going to be off air for a little while. But we will pick up the pieces, and thank you very much for all your charts. And I look forward to the next conversation where I shall be 9 hours different, I think, because I think the time change is about to happen. So I'll look forward to that. Watching your posts on Twitter, of course, and following you on Substack. And we've put all the links and things below, so people can get plenty of Tarric, even if not on DFA for a couple of cycles.
Well, thanks for the shout out, mate. And I'm looking forward to our next chat. There will be a whole lot to talk about.
Absolutely. Okay. Thanks very much. Take care. Have a good weekend. See ya.
Yeah, you too, mate. Bye.